Welcome to Talk Tickers, your go-to for breaking down the earnings reports that are really moving the needle. Today, we are digging into Colgate-Palmolive. They just reported their Q4 numbers, and honestly, the headline looked like a bit of a mess. But the stock absolutely ripped higher. So let's get into it and figure out exactly what happened.
And I mean, ripped higher. The stock shot up almost 6% on the day, and look at that trading volume, nearly double what it usually is. So this is the big question we've got to answer. Why? Why on earth did investors pile into a company that, on paper, just posted a loss? Let's unpack it.
Okay, so here's the deal. To really understand why the stock rallied, you have to learn to ignore the big, scary headline and look at what's going on underneath. And when you do that, you see that Colgate actually delivered a really solid beat on the metrics that Wall Street truly cares about. All right, let's look at the numbers that mattered. On the top line, revenue came in at $5.23 billion. That's over $100 million better than the street was looking for. A really nice beat. And even more important is what they call their base business EPS, or earnings per share. That hit 95 cents, a full 4 cents higher than expected. This tells you the core engine of the company, the toothpaste and pet food, is humming along just fine, actually better than fine. And this really gets to the heart of the story for this quarter. It was a tale of two completely different earnings reports wrapped up in one. You had the official, by-the-book accounting number, and then you had the story of the actual underlying business. And here's that split personality in black and white. On the left, you've got the official GAAP headline that everyone sees first, a loss of 5 cents per share. Ouch. But on the right, you have the base business story, a 95-cent profit that crushed estimates. The market, pretty decisively, decided to ignore the left side and trade based on the right. So, what in the world was behind that official loss?
The culprit has a very specific name, an impairment charge. That GAAP loss? It was entirely because of this. The company took a nearly $800 million write-down on its skin health business. Now, the key things to know here are that this is a non-cash charge. No money actually left the building. It's basically an accounting move to say, hey, this asset on our books isn't worth what we thought it was, so we're adjusting it. It has nothing to do with how much Crest or Hill Science diet they sold this quarter.
So, with that big accounting cleanup out of the way, the market could finally shift its focus to what's coming next. Let's take a look at management's game plan for the year ahead, because this is what really got investors excited. The CEO, Noah Wallace, came out with a message of pure confidence. He basically said, look, we know things are uncertain out there, but our strategy is solid, our plan is in place, and our team is the best. For a giant consumer staples company like Colgate, that's exactly the kind of steady, confident leadership the market wants to hear. No panic, just a focus on execution. And here's that plan put into numbers. Now, that sales growth guidance, 2 to 6%, is a pretty wide range, and that just shows they're acknowledging the global uncertainty. But the key thing is that they are still guiding for steady growth in both sales and their core earnings. Plus, they're planning on increasing their advertising spend, which means they're investing in their brands for the long haul. And I love this last part. They've already factored in known tariffs, total transparency, which is a huge plus. Okay, so let's tie this all together. It's time to finally answer that big question we started with. How does a company report a big, ugly headline loss and see its stock soar? Right, the official books show a loss, but the stock is up nearly 6%. How does that compute? Well, let's walk through the logic that drove the market's reaction. It's pretty clear. First, smart money zeroed in on that core business beat. That showed the engine is running great. Second, they correctly saw that massive impairment charge for what it was, a one-time, non-cash accounting cleanup, not a 5-alarm fire. Third, the forward guidance, even though it was wide, screamed stability and predictable growth. And finally, by taking that big write-down, management basically put the skin health issue in a box. They signaled that the bad news is known, it's been dealt with, and now it's time to move on. All right, so with all that analysis in our back pocket, here's our official take on what's next for Colgate. We're going to give you our prediction for next quarter, our outlook for the stock, and then we'll slap our final rating on it. For the next quarter, we're forecasting that their results will land pretty much smack in the middle of that guidance range. Management was pretty open about this on the earnings call. They expect really good strength from emerging markets to be offset by a bit of continued softness here in North America. It all points to a solid, steady, but probably not mind-blowing inline quarter. As for the stock itself, we think the momentum continues from here. With that skin health problem now officially in the rearview mirror, investors have a much cleaner story to look at.
That dark cloud is gone, and what's left is a strong cash-generating business. We believe that creates a clear runway for the stock to keep climbing. And that brings us to our official rating. We are calling Colgate-Palmolive an outperform. The company managed a really tricky quarter brilliantly. They showed the core business is strong, they cleaned up a problem area, and they set clear expectations. The market rewarded them for it, and we think that outperformance is just getting started. So to wrap up, let's have a little fun and talk about how someone might actually trade this view. But you know the drill. Here comes our standard disclaimer. This is just a trade idea for educational purposes. It is definitely not financial advice.
Okay, so the core thesis here is to bet on slow and steady winning the race. Colgate isn't a flashy tech stock, it's a stable giant. So a great way to play that is with what's called a bull call spread. Here's how it works. You buy a call option that's just a little bit above the current stock price. Then, to lower your cost, you simultaneously sell another call option that's even higher up. What this does is it lets you profit from the stock drifting higher, but it also caps your potential gains and, most importantly, it clearly defines your maximum risk. It's a really cost-effective way to get on board with a stable company in a pretty choppy market.
And one more time for the people in the back, this is not financial advice.